Hi, I hope this finds you healthy and safe wherever you are. My name's Kerry Meath-Sinkin. I'm a partner and wealth advisor with Meath Wealth Advisors. And today I want to share with you some important tax reminders. The reality is, even though this isn't maybe your favorite topic, a ton has changed between the Tax Cuts and Jobs Act, the Secure Act, everything that happened with the CARES Act and with COVID relief. There is more going on than ever, and it's really easy to miss different pieces. We're doing our best to bring this information to you in meetings, but I think it's great just to give a little more context and a little more information so you can understand some things at a high level and see if there's any specific pieces that are relevant for you that you want to call us about or you want to make sure you're talking with your accountant about as tax season approaches. And really the goal of all of this is to help you have greater ease, greater clarity by understanding what's going on, because when you understand these are the specific pieces that I need to be taking into account, your stress can go down and you can feel better, which is kind of the bigger reason why we're doing all of this. So with that, let's go ahead and jump in. What we're going to cover today is tax planning for the tax year 2020 and then things that we need to keep in mind moving forward. We're going to talk about individual taxes. We're going to talk a little bit about retirement planning, whether that impacts you or a loved one. We're going to talk a little bit about business planning. We'll keep that more high level, but if that fits for you, making sure you're taking advantage of all the different pieces. And then just some coming thoughts for 2021, and then finally some concluding thoughts, some things that you can take away. Individual tax planning opportunities. So let's take a minute to just remember everything that's happened in the last few years. We had the Tax Cuts and Jobs Act. That was followed by the Secure Act, which happened at the end of 2019. So it's one that people are really still integrating in a lot of different ways. We had the coronavirus impact, a lot of volatility, which has impacted things on a lot of different levels. Economic uncertainty. Of course, we had the elections, the CARES Act, and then finally the Appropriations Act and the COVID-19 Relief Act. And there's a lot of different things that impacted various kinds of taxes on different levels that you want to make sure you're taking into account. And before we jump into all of this, just a few reminders. Having a process, making sure that you have a good plan as you think about and prepare for your taxes is important. And one of the things that we encourage all of you to do is really make sure you're keeping good records, because as all of the tax changes are happening, certain things can retroactively impact your situation. So the better records you have, the more we're able to quickly look at different opportunities that might be available for you. Of course, gathering all your 1099s, this is something that we are happy to help you with. Coordinate with your accountant, upload that information, make sure you're getting everything that you need from us. Reviewing last year's tax return. We are reviewing tax returns more than ever, just because the impact of all of these changes has very real effects on how you think about tax strategy and tax planning. Of course, having the right team in place, making sure that you're claiming all of the income that's reported on your IRS. We know all of you are doing that. And then understanding if you need to plan for a tax payment or a tax refund. This is something that you can plan for ahead of time, so it's not as much of a surprise. And then, of course, just thinking about tax strategy and the impact that that has on you moving forward. These are, dates that we're all very familiar with, so I'm not going to spend a lot of time here, but we do not have an extension like we did last year. So make sure that by April 15th or October 15th, if you're extending, you're getting everything that you need to taken care of. The COVID-19 relief payments, we've gotten a few questions on these, so I want to make sure we address those. Those are not taxable. They are treated more like tax rebates, and that is true of the $600 checks at the end of the year, as well as the $1,200 CARES Act checks that came out this spring. So just know those are not taxable, but you will want to make sure that you record those on your taxes. Your accountant will probably ask for that information as well. And a question that we're getting a lot is, if, for example, your income in 2019 was greater than 2020 because of anything that might have happened related to COVID, you can still claim that refund. So make sure that you are putting that in, accounting for that correctly with your taxes, because it'll come more as a rebate through this specific tax season. So what will that look like at tax time? Let's say you lost your job in 2020, you made as a couple $100,000, but in 2019 you made $200,000. You will still be eligible for the $2,400 stimulus check from the CARES Act and the $1,200 end of year bill. So that's a pretty significant credit you want to make sure you're taking advantage of. And if you do, for example, still owe taxes from tax year 2020, that would come out of that refund, but you'll still get that, for example, $3,100 back if you owed $500. So just make sure that you're looking at the recovery rebate credit worksheet and you're accounting for that correctly, and you're correctly communicating with your accountant about this so you can get that benefit. Switching gears a little bit, a lot of times we look a lot at should we defer income into different years, and this is really dependent on your specific situation, but in some cases it could make sense to take more income this year if you're, for whatever tax reason that makes sense, or it could make sense to defer income. Things that we keep in mind with this are also what's going to happen to tax rates moving forward, and are there things that we should be doing now to make sure that you're in a really good position. So there's a lot of different things that you can look at here, and we've been talking about that with you if we think that applies in your situation. Another thing to keep in mind here is around flexible savings accounts and healthcare. So just something that's a little bit different is if your plan allows it, you are allowed to roll unused funds from 2020 to 2021. This is a new change just because of everything that happened with COVID. So just be aware of that. And then of course, on an annual basis, you do want to do your best to try to make sure you're utilizing those FSAs and you're not losing those additional dollars from the contribution you made. So just be sure that you're taking advantage of that, but know that there is a grace period right now if that went unused. Another quick thing is just out-of-pocket deductible healthcare floor was reduced from 10% to 7.5%. So that's just something that your accountant will likely be looking at, but something that you might want to be aware of. Charitable planning. Being tax efficient on this front is more important than ever. Since the Tax Cuts and Jobs Act, you no longer get the same federal benefits from charitable giving. And the reason is because the standard deduction is larger. You have to get above that standard deduction in order to get a benefit from your charitable giving at the federal level. So there's some really important things to keep in mind to make sure that you are able to give and supporting those charities that you love and you care about, but you're also doing it in a really tax efficient way. So one small thing that came about with the CARES Act in 2020 was a $300 above the line deduction for $300 cash gifts to various charities. So if this applied to you, make sure you're accounting for this in your taxes. In the year 2021, that's actually being doubled for married filers to $600, $300 for individuals. So again, just not a huge thing, but a small benefit you want to make sure you're taking advantage of. Probably the bigger things to make sure you're doing is if you're giving substantial amounts to various charities, make sure that you're talking with us about how you can get a benefit for it. So there's two big things that we're looking at. One, if you're over age 72, is qualified charitable distributions. This means that instead of taking out an RMD, paying tax on it, and then giving it to the charity, you're actually taking it directly from your IRA and giving it directly to the charity. So you're eliminating needing to pay taxes on it. So it's a really efficient way of giving. Another thing that we're doing a lot, especially for those of you that haven't reached age 72, is bunching strategies. So taking specific years where you're bunching all the contributions into one year, either with a direct donation to a charity that you care about or creating a donor advised fund. What that allows you to do is take the deduction in one year, but spread out your giving over multiple years. So if charitable giving is a big thing for you, please talk to us. Let's make sure that we're doing that really tax efficiently for you. Tax loss harvesting, this is not something that you need to be doing on your end, but just know this is something that we're looking a lot from our end at. And we're doing it in a few different ways. First, we're looking at tax allocation, so understanding the types of investments in your IRAs, the types of investments in your taxable accounts, making sure that they're right kinds of investments, in addition to the overall asset allocation that we talk with you so much about. But then throughout the year in those taxable accounts, we are looking to do tax loss harvesting so that we can keep especially short-term gains, but also long-term gains minimal. So that's just a piece that we're always working on, but really important as we think about being tax efficient on the planning side. Okay, next we're going to talk about retirement savings opportunities. And this is something that can have a pretty significant impact on your taxes both now and long term. So taking some time to understand what you're currently doing and doing some projections to make sure you understand what you should be doing moving forward is really important. So the first thing that we're going to talk about is just SEP contributions. If you are a small business or you work for a small business that doesn't have a plan, this is still something that you can do up until April 15th. Unlike your 401k or your 457 where contributions for 2020 ended in 2020, you can still contribute to a SEP if you file April 15th, and even if you extend that can go to October 15th. So make sure you're taking this into account. Just a few reminders, there's a 25% compensation cap for employees, 20% cap for self-employed owners, and then finally a $57,000 contribution cap per employee in 2020. So relatively low cost to doing this, not a lot of filing requirements, not as much flexibility, but if this is something that might apply for you and you have some of the additional resources to contribute to reduce your taxable income, this really may be something that we want to talk about in more detail. Other plans that you want to make sure that you're reviewing, 401ks. Here, the big takeaway is understand if you're contributing to a traditional 401k or a Roth 401k, and understand the impact of that both for you this year, and we're doing that with a lot of you through our tax analysis, and then also understanding what you think tax brackets might be moving forward for you. Does it make more sense to reduce your taxable income by contributing more to a traditional 401k, or does it make more sense to pay a little more in taxes now by contributing to a Roth, but long-term get some benefits from that? So something that's definitely worth taking some time to understand. Also thinking about profit sharing plans, is a simple something that you're contributing to defined benefit plans. Really understanding, are there ways that you can be more tax efficient? Are there plans that you can put in place now to really support yourself as you think about retirement savings? So again, any questions about this, please contact us. We're happy to talk with you more. Another big one here is IRAs and Roth IRAs. So again, you can still contribute here until April 15th for 2021. So that's something to keep in mind. Just a few reminders. That contribution is $6,000, $7,000 if you're 50 or older. And there's a lot of different ways you can do it. There are deductible and non-deductible IRA contributions. That depends a lot on your income. There's also Roth IRA contributions, which do have an income limit. And remember, there's no limit now. You can contribute after age 70 and a half. This was a recent change that happened. So let's jump into these in a little bit more detail. As we look at specifically traditional IRA ranges, here's just a few numbers to keep in mind. And remember that with traditional IRAs, being an active participant in another plan, such as a retirement plan through work, SEP IRA, matters. So if you are not contributing to any other plan, there's no limit on how much you're making as far as whether or not you can contribute to a deductible IRA. So that's something to make sure that you keep in mind. When we think about the ranges for a spouse of an active participant, it's a little bit different. So here you see higher levels. So for example, if your spouse is contributing to a plan, here's some things to keep in mind to see whether you can contribute to a plan. So if you're making $196,000 or less jointly, then you still do have an allowable deductible contribution. It's when you get above that 206 that you're phased out of the ability to do that. Now again, that doesn't mean you can't contribute to a non-deductible IRA, but the ability to take a deduction goes down. A big one here, and this is if you're filing separately, just some numbers to keep in mind, because sometimes people think, well, I should file individually, which you're not going to get a whole lot of benefit from that, but here's some numbers to keep in mind. Now, when it comes to Roth contributions, unlike with IRAs, where you get a deduction if you're not an active participant at any income level, with Roth IRAs, there are income limits. And once you jointly, as a couple, make more, or if you're a single filer, make more than that limit, you're no longer able to make a Roth contribution at all. So that's where looking instead at your Roth 401k, if that's an option for you, or getting creative in other ways makes a lot of sense. Perhaps a backdoor Roth or getting a little creative in how you look at it makes sense for you. Okay, switching gears a little bit, RMD planning. So a few key pieces to keep in mind here is RMDs are back for 2021. So as we know, in the year 2020, we did not need to take those. The age that you need to start has been pushed back to age 72. So that's just something to keep in mind. And RMDs are taxable distributions. So that's why taking a little bit of time, if you're younger, to understand how you're saving now, or taking some time to do Roth conversions makes a lot of sense, so you don't have increasingly high RMDs over time. So that's something we've been looking at Roth conversions with a lot of you. Again, looking at whether a qualified charitable distribution makes sense. We talked about that a little bit earlier. And then just looking at the impact of other benefits like Medicare and Social Security, because sometimes those can go up and you can reach different cliffs depending on what your planning looks like. But that's something that we're looking at with a lot of you. But just the big takeaway is, you know, for those of you who haven't yet started taking RMDs, that's been pushed back to age 72. There's even talk of that being pushed back to age 75, but nothing has happened there. And then RMDs are back. So that's planning that we need to make sure that we're taking into account for you. Okay, another one here is funding HSAs for 2020. Again, this is something that can still be done by April 15th, and HSAs are huge. We've been sharing this with a lot of you, but they're the only triple tax play. That means that you can put them in and get a tax break, they grow tax-free, and you can take them out tax-free for healthcare expenses. So this is a really big one. Make sure you're taking advantage of this if you have a high deductible plan that allows you to do that. And again, you can put in $3,550 if you're single, $7,100 for a family, and then an additional $1,000 catch-up over the age of 55. So this is a big one. We really encourage you to take advantage of this. And another big thing here is don't just think about this as being something you can use in the given year for taxes. Because it is the only triple tax play, instead what we encourage you to do is allow it to keep growing. Pay for expenses from current cash flow if you can do so, and then allow that to keep growing over time, because then you're going to have a much bigger number that you can use to help pay for health expenses as things go down. Another thing here is for small business owners, there are a lot of things to keep in mind, and we're going to be talking about that in more detail. But you know, just make sure you're thinking about the way that you're contributing, what you're doing, if there's different offset provisions as far as how it thinks about if you are someone that is over age 70 and a half and still working in a small business. Okay, that was a lot. But really getting savvy about how you are saving for retirement thinking about, again, both taxes now and taxes in the future, your future self is really going to thank you for doing that and making sure you're setting yourself up really well for retirement. Now we're going to switch gears and talk a little bit about tax planning for businesses. So if you do not have a business, if you're working for a larger company, this is a section that you can certainly kind of fast forward through. We're just going to end with some final key thoughts. But for those of you that this does apply to, it's worth taking a few minutes to just jump into it. There's a lot going on when it comes to tax planning for small businesses, and it really is important to keep sight both of what's happening now and then also thinking about what may be coming down the road in the future. So understanding, a lot of the different things that we've been talking about. We're going to jump in a little bit more to 199A, just high level information. Again, not to give you the full picture, but just so you know what to ask and you make sure you know what to be thinking about. So here, key business tax planning items. Of course, gathering all your documents, gathering all your receipts. With all of the changing laws, this is more important than ever. Understanding your 199A, how that's impacting things for you, making sure you're taking advantage of it. Getting qualified plan set up. This can be huge to allow you to take advantage of some of the deductions that you might be able to take. Deciding on certain deductions, looking at major purchases, understanding payroll taxes, looking at the impact of charitable giving for yourself, and then finally PPP loans, understanding what applies for you, what needs to apply for you. There is a lot. So make sure you're staying on top of this and you're taking advantage of various opportunities. 199A deductions and stretch issues. This is a big one. And, just basics. What we know about this is you get up to 20% deduction for qualified business income for business owners, pro rata pass through income. So this is one that I think people are still grappling with and understanding what makes sense, but it's a pretty complicated computation. So make sure you're working with someone who can help you understand what makes sense. And again, this is for sole props, LLCs, estates, trusts, S corps. W-2 income does not apply and qualify for this way of looking at things. Another thing to keep in mind is, are you a specified trade or business? So if you are, there's some other limitations that do exist, but just keep in mind, here are some of those numbers for single filers and joint filers. So again, if you're above those limits, really making sure that you are looking to save more into retirement plans, be charitably inclined, do things to help reduce your taxable income, because the savings can really be significant. Again, this is just service businesses, so understanding how this applies for you, but it's any trade or business involving the performance of services in these various fields. So by this point, you're probably familiar with if you fall into this camp, but just make sure to get really clear about that. Some key things here is the QBI deduction is done pro rata based on your ownership interest. And again, just really know your ranges. I can't emphasize this enough. Understand if you're going to be phased out of getting QBI and if there's things you can do to lower your taxable income so that you do still qualify. I want to take a second just to talk about how the 10-year stretch can impact the ability to take QBI. If you remember now, if you inherit a traditional IRA, you have to take that income out over 10 years, whereas before you could stretch that for a lot longer. So what can happen is if you inherit $1 million IRA, you now have to take out roughly $100,000 plus a year, and that's on top of your income from your business. So that can really impact your ability to take QBI. So again, there's a lot of planning here to take in mind, both from a legacy standpoint as well as your own ability to take QBI and how those income limits play out. So if we just take a minute to think about the impact of that, let's say you have a $100,000 IRA distribution in that year. that just resulted in $46,000 of additional taxes on that $100,000. Higher than the marginal tax rate, impacts the ability to take QBI. So a lot of planning here that you want to make sure you're keeping in mind. So there's a lot of different ways, not a lot, but there are some ways that you can reduce your taxable income. And as we talked about earlier, one of the best ones is through SEP planning. This is something that you can still do up until April 15th or October 15th if you're filing later. And in this specific example, it's pretty significant. So here a couple runs a consulting firm. They make $430,000 AGI. They're able to contribute $40,653 each to a SEP plus the HSA. That means about $88,306 of deduction that they can still take, which now gets them almost back, to the phase out ranges for QBI. So they're able to take advantage of the different deductions that are available. So again, there are still opportunities here. It just takes some time to think about what makes the most sense for you. All right, so there are some additional planning opportunities that you want to make sure you are taking into account. So we're going to run through these pretty quickly, but there can certainly be some impacts for you here. So just take a breath. Just know that net operating loss rules have changed. So if this is something that applies for you, make sure that you're looking at it with your accountant. Make sure you're understanding if you do have any ability to take advantage of this. So here we're just looking at eligibility for being able to take the net operating losses. So common situations would be a trade or business, casualty or theft losses from a natural disaster, which last year the whole United States was qualified under COVID. So just something to keep in mind. And then of course here with rental property. These are just some numbers, no summary, so I'm just really providing these for you for reference. We're not going to jump into these in more detail. The PPP loans, this is something we know a lot of you have already taken advantage of if it applies, but there is still an opportunity to take these. Just that loan forgiveness excluded from gross income. So if this is something that you haven't looked at yet, there are still some situations that we're finding. Make sure you do jump back and see what applies for you. PPP loans for 2021. This is more of a 2-week period starting February 24th. And businesses with fewer than 20 employees are able to apply for these PPP loans. So just take a minute again to understand if the changes to what you're able to take for the year 2020 is applicable and understand the impact that might have for you. So here, this is just a quick one. This may not make sense, but qualified new and used property acquired and placed into service in 2020, you can actually write off the entire cost in 2020. Again, that might not be a great idea if you expect tax rates to go up due to changes or you expect your income levels to rise, but it is something that you just want to make sure that you understand so you can make the right decision for yourself. Okay, so here, the QIP depreciation, this is just saying that 100% first year bonus depreciation also applies for real estate, qualified improvement property placed into service between 2018 and 2022. And that means that you can take 100% or do a 15-year straight line. This is improvement on interior portions of non-residential buildings. Again, there could be good reasons to forego that 100% deduction in 2020 and to take the 15-year, but you just want to make sure that you're deciding and making the right decision for yourself. Business meal expenses, this is one that's gotten overlooked, but just knowing that you are able to take 100% deduction in 2021 and 2022 for business meal expenses, as opposed to the 15% deductibility, and this was a result of the Tax Cuts and Jobs Act change. And again, that must be provided by a restaurant. As we think about charitable giving for corporations, previously they were able to give 10% of taxable income for cash gifts to charities. The CARES Act has extended that to 25% in 2020. And that was extended now into 2021. So again, I know this probably doesn't apply for many of you, but just something to be aware of if it does. Finally, rental assistance relief for real estate. This is a rental assistance program up to 12 months. 3 months in arrears can be extended for 3 months if necessary, and landlords can apply for this on behalf of tenants. This is a state program, so make sure you're checking on it. But this really can be significant if you do know someone where this is applicable. Employer payroll tax deferral. You can get the PPP and defer payroll tax. So again, this is something that came about as a result of the Secure Act, and it's just something that you want to make sure you're aware of if this is necessary for you and your business. And this payroll tax deferral has now been extended to the end of 2021. So just again, something to keep in mind if you are running a small business and this is something that could be impactful for you. Okay, we made it to the end. That was a lot of different information. Of course, this wasn't exhaustive, but we just wanted to cover some of the big highlights that we think make sense for you. Big takeaways here. Tax refund credits and 2020 changes. Again, retirement savings opportunities. There's a lot of planning to do on this front to make sure you're thinking about things in the right way, both before retirement as well as after. Business planning, of course, is more important than ever. There's more opportunities to pay attention to all of this. And then, of course, just staying ahead of tax season, really reviewing tax strategy between the Tax Cuts and Jobs Act, the Secure Act, everything that came down the pike last year. There is a ton going on, and it's really easy to miss things. So really being savvy on the tax side is essential as you think about both yourself and or a business that you might have. Thank you so much for watching. We are here. Please reach out to us if you have any questions. Feel free to send this along to anyone you think it might be helpful for. We're just happy to be a resource and continue to provide you with up-to-date information. Thank you again. Take care.